Okay, moving to this. Okay, so now we do, it's actually the core of this chapter. The most important part of this chapter are investment banking functions. So what are the functions? So 7. Yeah. I guess we're going to get them late. Functions is the same as activities. What are investment banking activities? Question is, what do investment banks do? And I have, that's the core of the chapter, 7 activities. Number 1. Investing. Number 1. Investing. They will do fund management. In other words, they'll be in the business of investing. Remember, investment banks' main function will be issuing securities, but they'll be doing investing. So, number 1, they'll be doing fund management. They'll be doing mutual funds. So there's going to be a mutual fund and they'll run the mutual fund. They will manage the mutual fund. They'll also manage pension funds. So a lot of companies will have their pension fund invested with the investment bank. Of course, you can have your pension fund run by a commercial bank, but investment banks do a lot of fund management, as in investment fund management. Part of the investing will be, and they will be doing the investing to generate fees. In other words, they'll run the fund, the mutual fund, for the benefit of investors, but they won't profit if the market goes up or if the market goes down. All they do is generate fee. They'll charge 1%. So, let's say if you have $20,000 in the fund, they'll charge you this year $200. Whether it goes up, whether it goes down, it is not their risk. The investment is yours. All they do is they manage it for you. They'll get 1% of your $20,000 and they'll generate fee. In other words, they'll manage the fund in return for a fee. The typical fee is 1%. And they will be measured on what's called either benchmark performance. When you're a fund, usually you will compare yourself either to other mutual funds, or most commonly you'll compare yourself to the stock market, as in to the S&P 500 or to Dow Jones or to NASDAQ. So benchmark performance means that you measure your performance against some widely known benchmark. The alternative to benchmark performance is called risk adjusted. Risk adjusted performance. You measure your performance according to the risk. You may run a high-risk fund. And if you run a high-risk fund, the expected return will be higher. Or you may run a very low-risk fund, like bond fund, and it will be lower. You may generate, as an investment bank, as a fund, the lowest risk, barely 1%, based on money market mutual fund. But your risk-adjusted performance may be very good. In other words, you took pretty much zero risk. You invested mostly in treasuries and other extremely low-risk money market instruments, and you made 1% return. And that could be better than 3% return on junk bonds. Because investors think, oh, I better take 3% on junk bonds. Well, no, not for the risk that you're taking. Because if you're taking now 3% on junk bonds, next year you might take minus 20% or 20% loss on the junk bonds. It might be better to take 1% on the money market mutual fund this year and 1% on the money market mutual fund next year. So you'll have to separate the two, okay? Yeah, soon. All right. So, number one is investing. Number two, you can also think mostly as fund management. Number two is, I've already discussed plenty. I can cut this short, investment banking. Investment banking is, in this particular case, exactly the same as securities underwriting. So, a very short way of saying number two is underwriting. Okay, that's all you say, underwriting. So the second main function is underwriting. Okay. The issue may be primary, meaning security will be traded on the primary market for the first time. It's issuing new securities. This will be the IPO I spoke about. So it's going to be underwriting securities on the primary market, or it could be underwriting securities on the secondary market. In other words, the security already trades, and they'll issue a few more securities. This is, I've been explaining it early on from the previous chapter, meaning seasoned. Seasoned. So, the primary will be, if you issue stock, the stock is either IPO, stock was never traded before and will trade for the first time, or you issue more stock, the stock's already trading. So you already have 10 million shares trading, and they'll issue another 5 million. So it's either IPO or it is seasoned. Okay, a lot of this investment banking is actually based on public confidence. So here, a major determinant of success is the investment bank trustworthy or not? Can you trust an investment bank? And the short answer is, you should know as investors, you can't trust them, okay? Usually, investment banks are always associated with some sort of a fraud. They play financial games. The name of the game is called screw the customer, screw the investor. Usually, investment banker makes money when the investor on the other side loses money. Okay, so for them to make money, they have to somehow cheat the customer out of it. Most customers understand it, so it's critical to keep the trust of the customers and having a public confidence. Public confidence is a very important part for this function. And a lot of investment banking and underwriting depends critically on the stock market, as in stock market performance. This means the following: when the stock market goes up, up, and everybody is making money and is eager to invest, it is very easy to issue and sell new securities and make a lot of profit. When the market is going down, usually it's very hard to sell securities. So, stock market is extremely important for the investment banking or the underwriting business of an investment bank. Good stock market means good underwriting fees. They work for fees, underwriting fees. And the fee is usually based on I've taught it a few chapters ago, the underwriting spread. And the underwriting spread was the difference between the gross proceeds, which is what investment bank gets from the customers, and the net proceeds, which is what the issuer gets from the investment bank. So the underwriting spread and overall underwriting business depends on the stock market. Good stock markets, investment bankers get rich. In bad stock market, they go hungry. Next, let's see what else they do. Oh, part of underwriting will be sometimes research, as in investment research. Now, investment research will be a completely different and separate function. But the idea is the following. The investment banker will provide a research on the particular company, and they'll tell you, oh, we think that Apple is a very good company and are going to make a lot of money by investing in that particular stock. Well, this investment research, when coupled with underwriting, leads to what is known in investments, well, in finance, in economics, as, or in law, conflict of interest. Conflict of interest means that when they do a research on a stock which they underwrite, it is in their interest to tell you, this stock is very good, this stock is going to do well, buy a lot of this stock, okay? Because if they tell you great things about the stock, their underwriting business will do better. If they tell you the truth, their underwriting business will suffer. This is the conflict of interest, that the reason that you can't trust an investment bank. The investment bank will always tell you that the stock is great and the investment is great because they will profit from the underwriting and other businesses from it. So, whenever an investment bank gives you an advice, the short answer is don't trust it because of the conflict of interest. Or you have to research to find out, does the investment bank have a conflict of interest, meaning doing other business with the particular research company. If they do other business, you can't trust them, okay? If they don't do, maybe they have what's called unbiased research. So, investment research is considered to be biased, driven by conflict of interest, driven by hope and expectation of more in other business, or unbiased. Unbiased means you have no business relationship with the company. You don't expect any future relationship with that particular company. And you have no reason to provide a bias. In other words, you have no conflict of interest. In other words, conflict of interest results in biased research. All right, let's see what else we got. Okay, again, the issuance, the security, I'm only summarizing. I've covered it many times before. Could be public or it could be private. Public means for a general sale to the general public. Private will mean only to selected financial institutions and to a select group of investors called qualified investors, which are high net worth and relatively sophisticated. I already covered, will only repeat, underwriting could be based on best efforts, strictly for a fee, or it could be firm commitment, working on a underwriting spread. And it's possible in this particular function that they act as a primary dealer. Now remember, a primary dealer, that's from the bond market, is one of the 20 dealers authorized by the government to sell. In other words, they buy the securities, the treasuries from the government, and then they resell them to other mutual funds, hedge funds, and whatnot. In this particular case, they act as underwriters. They buy the securities from the government, okay, and then they resell them. In other words, they work on a firm commitment with respect to the U.S. government treasury. Number 2. Number 3, market making. When you make a market, you must be always offering, well, not always, must be offering to buy and offering to sell. The only way that you can offer to sell a stock is if you own it. So, if you market make, you must have an inventory. Inventory is a security which you own, intended to be sold immediately to a customer who wants to buy it at the current price. So, an inventory is a security that is on offer for sale at a particular price, which will be sold as soon as first buyer comes. But it's not too different from the inventory of the supermarket. Of course, the supermarket, they got, let's say, inventory of Coca-Cola. You walk in, there's a price sticker, 60 cents, you pay, you take it. Inventory will be also with cars. You go to a car dealer, he's got 20 cars in inventory. The car's got a sticker price, you pay the price, you take the car right away. It's exactly the same with securities inventory. So, market makers will maintain an inventory of securities. Okay. The next thing is, okay, I'll use it here. Market making could involve agency transactions, or could involve, and the agency transaction will be acting as a broker. I've already covered that. Sometimes we call these stock broker, if the broker is brokering stocks, okay? They could be brokers in something else, okay? They could possibly even broker loans. That's a different topic. And it's for a fee. And the other one will be principal. Principal transactions. In a principal transaction, they do for themselves. They'll buy, they'll sell. So, in an agency transaction, you do the transaction for someone else, on behalf of someone else. Someone else will make the profit, someone else will make the loss. In an agency transaction, you act as a broker and you make a fee. Let's say $20 for a buy and for a sell. That's all you make. All the risk is by the customer. In a principal transaction, you buy it for yourself. If the price goes up, you make money, and if the price goes down, you lose money. But it's not investing, it's market making. You buy it, and as soon as the next guy comes, you sell it to him. Or if somebody sells you, you buy, you sell. So either way, someone comes, you buy, and then you sell, or the opposite. When you act as a principal, you must maintain inventory. So inventory is required to act as a principal. If you act as a principal market maker, you must maintain inventory so that when the buyer comes, you already have it and you can immediately sell. Let's see what else we got here. Okay. Now, when you act as a broker, well, I'll do this over here. When you act as a broker, the customer will usually come and they'll call you on the phone, but most likely they'll go to the website, they'll put in their order, whatnot. You are exposed to what is known as a technology risk. This is the risk that the technology, the software, the website, the database, the payment system, in other words, your computer systems and software systems, which are supposed to work properly, for some reason don't work, or stop working, or make a mistake while working. Okay, you buy shares for 10,000 and the software records 100,000. Or you sold shares and instead of giving you money for those shares, it takes money. So it reduces the shares and it reduces the money in our account. That's a technology mistake, software mistake. So you expose yourself to a lot of technology risk over here. Let's see what else we got here. All right, well, that's good enough. Next. Number 4. Investment banks engage in trading. They are big traders. And again, they'll trade in literally everything. They'll trade in stocks, they'll trade in bonds, they'll trade in currencies, they'll trade in derivatives. Now, for some of them, they'll actually trade. For others, they'll do market making. Now, the important part to understand, which I began with, the first one, is that it is, for an investment bank, perfectly normal to do all of them at the same time. They will, first, for example, they will issue a security of a particular stock, let's say IBM or Apple. So when they issue the security, they'll engage themselves in underwriting. Then they'll do research on the stock. Later on, they will do market making. They'll become a market maker on the stock. So they'll try, when you are market maker and you have to maintain inventory and you act as a principal, the main benefit will be you provide liquidity to the market. In other words, you provide marketing, that will be the research, okay, you make it popular, you provide liquidity. Well, they can provide liquidity, but further on they can trade. They just trade for their own account and they try to profit when they trade. Well, here's the problem with investment banks. When investment banks trade, they don't usually trade against the market. Turns out, in the real world, they trade against their customers. And investment bankers trading is profitable when the customers take a loss. In the trading part is where investment banks usually make a lot of money out of their customers as customers' loss. So here is where they screw their customers. A lot of times when they make a trade and make a big trade, then they'll change their research and research recommendations to match their trade. They say, well, we think that this stock is going to go up. They first trade, they buy 1 or 10 million shares, and then they change their research and say, we think this stock is going to go up, and they want to sell you the shares. Well, they'll sell you the shares which they bought yesterday, okay? So they will be effectively profiting. In other words, they will trade number one on the market against the market. But trading against the market is risky. The market can do anything on you or against you. So it's much better, much safer to trade against your customers, your own customers, especially your own brokerage customers. All right. This is known as pump and dump. They think the stock is going to go up. They buy some of it. They pump it. Means, hey, this stock is great. You want to buy 20 shares. You want to buy 2,000 shares. You want to buy 20,000 shares. They already bought. So they pump the price. And as the price goes up, they dump the shares onto their customers, usually retail investors. Now that's a classic scam which investment bankers do. Okay, they can create securities. That was something else that investment banks did. They create a security. That's during the 2007-8 financial crisis. They'll create a security. They think the security price is going to go down. They sell the security to their customers, and then on top of that, they short the security. Where if the security goes down further, they'll profit. So they profit once on creating the security, they profit second time on selling the security for the fee, they profit a third time on shorting the security, and if the security indeed goes down, they will effectively profit a third time out of it, okay? And they say, well, they use it as part of their trading. Sometimes they say, well, we do it as part of the market trading. There is sometimes little difference between market making and trading. With market making, they'll be always having a bid and an offer. With trading, they may be taking only the one side for a while. Let's say this week we're only buying, the next week we're only selling, okay? An investment bank can't just, like a little trader, buy a little, sell a little, okay? Because if they're buying and selling just a few shares, they can't make a lot of money. If you and me work with, let's say, 50 shares, 100 shares, or 1,000 shares, they work with 1 million shares or 5 million shares. So when the investment bank decides to buy, it will move the market. When they might buy 2 million shares, they will drive the market up. If they decide to sell 2 million shares, it will drive the market down. So when they do trading, it's going to take them a little while to execute a trade for 5 million shares. All right. All right, well, we got a few more here. Trading could be position trading, which is what I've been explaining for a while. Position trading is you take a position, let's say long, and expect within 2, 3, 10 days that the stock's going to go up, and when it goes up, you begin to sell. So position trading involves, usually, you hold the position for a couple of weeks, usually. The next one could be, next type of trading is called number 2, pure arbitrage, or arbitrage. Arbitrage is actually a transaction which involves buying of a security on one market and selling it on another market because there is a little price difference. So you may buy it in New York and sell it in Tokyo. That could be a currency, it could be a stock. Or a certain security may be trading both on Hong Kong market and New York market, and they may be, for a couple of seconds, a slight difference in the price. Let's say the security trades for $19.02, and over there $19.04. And if they see a 2-cent difference, they'll immediately trade back and forth, meaning on the one place they'll sell the higher price, on the other place they buy the lower price, and that's called an arbitrage. Means buying where it's cheaper on one place and selling where it's more expensive on another place. Next one is called risk arbitrage. All right, this is trickier. Risk arbitrage is you usually buy a security in the expectation that there will be some news release, that there will be some event. The typical event may be merger. So you think the company is going to do a merger. It may be an acquisition. You think someone's going to acquire the company because it's a good target company. And you think that if the stock trades at 18, someone will come along and offer 25 to buy the stock as a merger or as an acquisition. Okay, well, it's important to understand that this, which they call risk arbitrage, is not an arbitrage. It's not an arbitrage at all. It is pure speculation. It's yet again a word used in finance which is meant to confuse others, which is meant to misrepresent order. Risk arbitrage is not an arbitrage at all. Risk arbitrage is a speculation that there will be a merger, acquisition, or some other event that will move the stock significantly higher or significantly lower, and they take the risk that there will be indeed a merger, or there will be indeed an acquisition. In other words, they think there will be news, okay? They'll take the position so that when the news comes, they'll do the opposite. So, if they think there's a merger, when the merger comes, then they'll sell. That's risk arbitrage, but it's not an arbitrage at all. Number 4 is, and I've covered a little bit on the stocks, program trading. Program trading will involve transactions, let's say worth more than $1 million. It will involve transactions of more than 15 or 20 stocks, usually way more, could be 50, could be 200 stocks. Usually program trading will involve buying on one market, selling on another market. Usually program trading will involve, but not always, a spot transaction on a spot market, and usually, but not always, a futures transaction on another market. And usually a program trade may actually be some form of an arbitrage. They think that the futures market is slightly overpriced and the spot market is underpriced. But the spot market, let's say the futures is Dow Jones Industrial Index, will be 30 stocks. So they may actually buy the 30 stocks on the spot market and sell the futures, or the other way around. But again, program trading is simply defined, let me try and get it, simultaneous buying and selling of a portfolio of at least 15 stocks. So, selling of 15, buying and selling 15 stocks worth at least $1 million. Okay, that's the definition. But it will usually involve, could involve only futures, could involve only spot, but usually involves both at the same time. A few more minutes. Number 5. Cash management. So, before I discussed, I think number 1 is fund management, is in investment management. Now it's cash management. Let's see what's cash management. They can provide what's called cash management accounts. Let's see what's cash management account. Well, it's basically a money market mutual funds, okay? But with check writing privilege, check writing. In other words, hey, we put your money in a money market mutual fund, maybe you'll make 2 or 3% return, and you can actually write a check on it. Or, better, but not always, but rarely, we'll give you a debit card against your money market mutual fund. So it's kind of like a bank deposit, but it's not a deposit. It's technically an investment. Remember, an investment bank is prohibited from taking a deposit or accepting a deposit, okay? As soon as it accepts a deposit, it becomes a commercial bank. But they can take your money, they're going to invest it in treasuries, okay? And if you need the money, they'll sell some treasuries and give you back the cash. Usually the cash will be in the form of a check. You can just write the check and make a payment. So that's a cash management account. Let's see what else we got. Oh, okay. Well, that's it. It's a very important development. Because of cash management, the cash management account acts as a deposit. It functions as a deposit, but it's legally not a deposit. So, because of this particular function, the difference between a commercial bank and investment bank becomes blurry. All right? In other words, this is kind of like accepting a deposit, but because it's not legally and technically a deposit, it's not a commercial bank. But they act like a commercial bank and they behave like a commercial. Now you can write the check. Maybe you can even get a debit card or whatever. So this particular cash management function blurs the distinction between commercial and investment banking. This is known, this particular is called, is an example of a financial innovation. In other words, you introduce a new financial product, cash management account, and this new financial product suddenly makes an investment bank behave, function just like a commercial bank. Okay, so that's a very good example. So that's one of the primary reasons where, as a function, investment bank is now kind of like a commercial bank. Let's see what else. Number 6. Okay, we'll take a break. We'll finish for today. Next time.